Okay, stop scrolling, I need you to hear this. 21 million barrels of oil move through one stretch of water every single day. And somebody right now is threatening to shut it down. Not in a movie, not in a simulation. Right now, and I know what you're thinking. You're thinking, okay, that's a Middle East thing, that's a politics thing, that's not my problem. Bro. It is absolutely your problem. And by the end of this video, you're going to see exactly why and exactly what to do about it. Let me paint you a picture real quick. Think of the entire global economy like a power grid. Every factory, every airline, every supermarket, every gas station you've ever been to, all of it is plugged into this grid. Now imagine there's one circuit breaker, one switch. And if that switch flips off, cities start going dark, not metaphorically, economically. That switch has a name. It's called the Strait of Hormuz, and Iran just walked into the control room. That's what this video is about, not the politics, not the drama, the money. Where it's going, why it's moving, and how regular people like you and me, can actually be on the right side of this instead of getting blindsided like everyone else. Let me tell you about Derek real quick. Derek is the guy who did everything right. He had his stocks, his bonds, a little crypto on the side. He read the news every morning. He felt like he was on top of things. March 2022, Russia invades Ukraine, and in 6 days, Derek loses 18% of his portfolio. He didn't do anything wrong. He was asleep. He just didn't understand what was actually happening underneath the headlines, and that's the thing. The people who made money that same week weren't some genius hedge fund wizards. They just understood one thing Derek didn't. Geopolitical shocks don't just create chaos, they create predictable chaos. Say that again, predictable chaos. There's a pattern. There's always been a pattern. And once you learn to see it, you're never going to look at breaking news the same way again. The Iran situation is running that exact same pattern right now. And most people watching this are going to do what Derek did: watch, freeze, and then wonder what happened. I don't want that to be you. That's literally why I'm making this video. Okay, so here's where most people get it completely wrong. They think to understand what Iran means for your money, you need to understand Iranian politics. You need to understand the nuclear deal, the sanctions, the factions, all of that. You really don't. Here's how I think about it. Politics is the theater. Money is the script. The actors change. The script doesn't. So let's talk about what's actually under the hood here. 21%, that's the number you need to know. 21% of all the oil that gets moved by sea on this entire planet goes through the Strait of Hormuz, through one channel. Think about how insane that is for a second. If that channel gets blocked, even for 7 days, just a week, Goldman Sachs analysts have actually modeled this out. Oil jumps $30 to $50 per barrel. Overnight, not over a month, overnight. And if it stays blocked for 30 days, we're not talking about a rough quarter for your portfolio. We're talking about the kind of supply shock that kicks off a full recession. The kind where central banks are having emergency meetings and unemployment is actually rising. Now look, this has happened before. 1973, OPEC cut oil exports by 5%. 5, that's it. Oil prices quadrupled in 4 months. We're not talking about a 5% cut this time. We're potentially talking about 21% of global seaborne supply gone. And you know what the mainstream advice is right now? Stay diversified, don't panic, trust the process. I'm not saying that advice is always wrong. For a normal market, fine, sure, but this is not a normal market. And the problem with that advice right now is that the standard portfolio, your 60% stocks, 30% bonds, 10% cash, that whole model is built on assumptions that collapse the second energy prices spike hard. Bonds go down because inflation forces interest rates up. Stocks go down because company costs explode and margins get crushed. And cash just quietly loses value every single day. So the diversified portfolio isn't protecting you. It's just failing in 3 different directions at the same time, which is honestly kind of impressive in the worst possible way. Stay with me here, because in a couple minutes I'm going to show you the actual move that flips this whole script. But you need to see this next part first, because without it, the move won't make any sense. Alright, this is where it gets interesting. Because here's the thing nobody talks about, and I mean nobody, not on the news, not on the finance subreddits, not in your K-literature. Every single crisis has a beneficiary. Every time there's chaos in the energy markets, a specific set of assets doesn't just survive, they go absolutely vertical. And most people are so busy panicking about the thing going wrong that they completely miss the thing going right. So when the Strait of Hormuz gets threatened, what actually explodes? Not tech, not crypto, not gold. Well, gold moves too, but that's not the big one. It's tanker shipping stocks. Here's why, and this is so simple once you see it. If the normal route through the strait gets shut down, every single barrel of oil has to take the long way, around the bottom of Africa, around the Cape of Good Hope. That adds 15 days to every voyage, 15 days. So now the world needs 3, 4, maybe 5 times as many tanker ship days to move the same amount of oil. The demand for tankers goes through the roof. The rates companies charge to rent those tankers goes through the roof. And the profits and the stock prices go through the roof. During the Russia-Ukraine crisis in 2022, tanker stocks went up 80 to 120% in 3 months. In 2019, when there were tensions around Hormuz, tanker day rates jumped 300% in a matter of weeks. 300% in weeks. Now let me tell you about someone named Priya. Priya is not a finance person. She's a veterinary technician, but for 3 years she'd been quietly studying what she called crisis assets, just the stuff that tends to move in a specific direction when the world gets stressed. February 2022, everyone's panicking. Derek's watching his portfolio drop. Twitter is on fire. Priya puts $8,000 into tanker shipping IPs. 60 days later, she sells at $19,400. She didn't have inside information. She didn't predict Putin. She just had a framework she built before the chaos started. And when the chaos came, she was ready for it. That's it. That's the whole secret. Being ready before it happens. Now here's the map, because this stuff isn't random. When oil supply gets disrupted, 2 types of things go up. Energy companies and tanker stocks on one side. Gold and inflation-protected assets on the other. 2 types of things go down. Airlines, because they run on fuel and their margins are already paper thin. And high-growth tech, because when inflation forces interest rates up, the math on future earnings gets brutal and valuations collapse. This isn't a prediction. This is a pattern. It's played out the same way over and over. And now you know the map. Most people stop here. They understand the pattern, they feel smart about it, they go back to their day and they do absolutely nothing with it. But the people who actually win, the people who go from 30% returns to 150% returns, they do one more thing. And I'm about to show you exactly what it is. Okay, let's get into the actual mechanics, the real step-by-step. This is the part that feels complicated from the outside. It's really not. Just stay with me for a minute. Step 1 is reading the temperature. You don't need a Bloomberg terminal. You need 3 things to watch. Is the Iran nuclear deal alive or dead? When talks break down, risk goes up. When talks start again, risk comes down. That's your first signal. How often is Iran's Revolutionary Guard Navy running exercises in the Gulf? More exercises means more tension. This is public information. You can track it. And where are U.S. carrier strike groups positioned? When a second carrier moves into the region, that's a signal. The U.S. government publishes this. And here's something most people don't know. The U.S. Energy Information Administration puts out a free weekly report on Hormuz risk. Free, public, takes 4 minutes to read. Almost nobody reads it. Step 2 is sizing your position correctly. This is where most people mess up. They either completely ignore the opportunity or they go way too hard on it. The right move is 3 to 7% of your investable capital. Think of it like an insurance policy, not a lottery ticket. An insurance policy that pays out big if things go sideways. Within that, half into a broad energy ETF, 30% into tanker exposure specifically, 20% into hard assets like gold or inflation-protected treasuries. If nothing happens, you underperform slightly. If the circuit breaker trips, that 5% position can return 40, 60, 100%, and it hedges the losses everywhere else in your portfolio at the same time. Step 3, and this is the one people skip, know your exit before you ever enter. Write it down. Literally write it down before you buy anything. Something like, if I'm up 30%, I sell half. If there's a real peace deal or a credible diplomatic signal, I'm fully out within 48 hours. Why 48 hours specifically? Because markets price in good news way faster than they price in bad news. The moment a ceasefire announcement hits, tanker stocks can give back weeks of gains in a single session. You need to be moving before the crowd catches up. Step 4, the math that makes this make sense. Let's say you put $5,000 into this position. Scenario A, nothing happens. Iran backs down, everyone exhales, your position underperforms. Maybe you're down 10%, that's $500. Scenario B, the strait gets disrupted, even partially, even just threatened more seriously. Your position goes up 60 to 80%. On $5,000, that's $3,000 to $4,000 in gains. Now here's the key question. What's the actual probability of disruption? Let's be conservative. Let's say 20%, 1 in 5. Run the expected value, 80% chance of losing 500, 20% chance of gaining 4,000. That math gives you a positive $400 expected value, even at 1 in 5 odds. The math works. This is how professionals think about it. Not is this definitely going to happen, but what's the payoff structure, and does it make sense even if it doesn't? That shift in thinking, that's the whole game. I know what some of you are thinking right now. You're thinking this sounds risky. You're thinking this sounds like speculation. Maybe you're thinking I sound like one of those guys. I hear you, and I want to talk about that directly. Because here's the thing, risky and speculative are the exact words that get used to keep regular people out of positions that institutional money has already taken. You know who's not worried about this being too risky right now? Norway's sovereign wealth fund, $1.6 trillion, has been increasing energy exposure for 18 months straight. The world's largest commodity trading advisors have been positioned long on oil volatility since Q. Middle Eastern sovereign funds have been quietly buying tanker shipping equities for 2 years. These are not cowboys. These are the most conservative, most risk-managed pools of capital in the world, and they are positioned for exactly what we've been talking about. So when someone tells you this is too speculative, ask yourself who's actually speculating. Now, the classic line, don't try to time the market. I'm not going to pretend that's bad advice in general. For long-term index investing, that's fine, that's real. But nobody told Priya not to time the tanker trade. Nobody told the people who bought energy stocks in January 2022 not to time it. They made 80% in 8 weeks. Don't time the market means don't try to guess random noise. It doesn't mean ignore a structural, geopolitical, mathematically predictable supply shock. Those are completely different things, and mixing them up is a very expensive mistake. So let me give you 3 questions. Answer yes to all 3, and this is not speculation. This is structured asymmetric risk-taking. Is your total position under 7% of your investable capital? Yes, good. Do you have a written exit trigger before you enter? Yes, good. If this position goes to absolute 0, does your life still work? Yes, then you're not gambling. You're doing what every serious macro investor does. You're taking a calibrated position on a predictable type of uncertainty. Big difference, a very profitable difference. Okay, real quick, here's something I didn't put in the title. Something most people aren't even thinking about. It's called the second order play. And honestly, this is the thing that separates the people who made 30% from the people who made 150. Here's how it works. When oil spikes, it doesn't just move oil stocks. It sends a shockwave through every supply chain. Shipping costs go up for everything. And that hits companies that import physical goods really, really hard, especially the ones with thin margins who can't just pass the costs on to customers. Discount retailers, fast fashion brands, consumer goods companies with long import chains. So while everyone else is piling into the obvious energy longs and making those trades crowded and expensive, you're looking 2 steps downstream at the companies that are about to get quietly destroyed. You go long the winners. You go short the predictable losers. Every single earnings call during the last 3 energy crises mentioned elevated freight and input costs as a margin killer. It's not hidden. It's in public filings, it's repeatable, you just have to be looking for it. And here's what you can actually do tonight, not next week, tonight. Google the US EIA Weekly Petroleum Situation Report, pull it up, read the Hormuz section, 4 minutes of your evening, then look at your own portfolio and honestly ask, if oil jumps 40% tomorrow morning, where does this hurt me? Name it, airlines, tech-heavy, bond-heavy, just name the vulnerability, and then write down what a 3 to 5% crisis allocation looks like for you, even if you don't buy anything yet. 3 assets, a position size, and exit trigger. Just write it down, because the people who win in moments like this weren't reacting to the crisis, they were ready for it. Long before it became a headline, look, the circuit breaker is live. Iran is in that control room right now, and whether you know it or not, this is already touching your life. It's in gas prices, it's in shipping costs, it's in the price of things showing up at your door. The only question is what side of this you're on. Are you Derek, who did everything right, watched it all happen, and still lost 18%? Or are you Priya, who built her framework before the chaos and let the chaos work for her? That decision gets made before the crisis, not during it. And if this video changed the way you see what's happening right now, drop something in the comments. Seriously, tell me if this hit different than what you normally see out there. I read those, everyone. Because if you think this was eye-opening, wait until you see what comes next. The Strait of Hormuz doesn't work alone. It has a twin Chokepoint. Less talked about, less understood, and honestly already under more pressure than Hormuz is right now. The Strait of Hormuz explained like your 5 is next. And that's where this whole map gets 3 times more dangerous and 3 times more profitable for the people who understand it. I'll see you in there.